The regulatory landscape in the cryptocurrency market is undergoing a significant shakeup, both in America and around the world. It is crucial for crypto enthusiasts to stay informed about these changes and understand their implications, especially for altcoin projects. In today's video, we will delve into some of the recent developments and their potential impact on the crypto market. Make sure to subscribe to the channel for daily crypto coverage and stay updated on all the latest news. Binance and Canada. Binance, one of the leading cryptocurrency exchanges, has recently announced its withdrawal from the Canadian market. This decision has raised eyebrows and sparked discussions within the crypto community. The reasons behind Binance's exit from Canada can be attributed to the new guidance issued by Canadian regulators. These guidelines have had a significant impact on the country's crypto industry, making it no longer tenable for Binance to operate there. The new guidance introduced by Canadian regulators revolves around stable coins and investor limits. Unfortunately, these guidelines prohibit firms from allowing Canadian clients to engage in crypto contracts to buy or sell any crypto asset that is deemed a security or derivative. Furthermore, the definition of stablecoins as securities has added to the complexity of the situation. These regulatory developments have ultimately led Binance to take a proactive approach by withdrawing from the Canadian market. Binance's departure from Canada carries implications for the overall market. As one of the largest and most influential cryptocurrency exchanges, Binance's actions can set a precedent and influence other exchanges and investors. The decision sheds light on the challenges and uncertainties faced by crypto businesses in navigating regulatory frameworks, and it underscores the need for clear and comprehensive regulations to foster a healthy and thriving crypto industry. Florida and CBDCs. Florida's governor, Ron DeSantis, has made headlines by enacting a ban on centralized digital dollars, commonly known as CBDCs, within the state. DeSantis has been vocal in his opposition to CBDCs, referring to them as part of woke politics, and even going as far as calling them Big Brother's digital dollar. Governor DeSantis' move to ban CBDCs in Florida carries significant implications. It reflects his stance on preserving economic freedom and resisting what he perceives as an overreach of government surveillance and control. By banning CBDCs, DeSantis aims to protect individuals' personal finances and ensure that Florida remains a state that supports financial innovation while safeguarding against government influence. This decision also comes in response to President Biden's executive order exploring the creation of a U.S. central bank digital currency. While cryptocurrencies like Bitcoin operate independently and decentralized, CBDCs are centralized and directly controlled by the government. DeSantis' call on the legislature to pass legislation explicitly forbidding the use of CBDCs in Florida's Uniform Commercial Code aligns with his commitment to maintaining financial sovereignty and resisting potential intrusions on individual privacy. Governor DeSantis' ban on CBDCs in Florida holds significance beyond the state's borders. It highlights the ongoing debate surrounding the adoption of CBDCs on a national scale. With President Biden's executive order exploring the creation of a U.S. central bank digital currency, the ban in Florida sets a precedent and may spark discussions in other states regarding the use of CBDCs. It demonstrates the potential for state-level resistance against centralized digital currencies and their potential implications for economic freedom and privacy. The ban on CBDCs also takes into account the broader geopolitical context, particularly the increased influence of China and its plans to adopt CBDCs on a global scale. By prohibiting any CBDC issued by a foreign reserve or government-sanctioned central bank, Florida aims to prevent the adoption of a worldwide digital currency within its jurisdiction. This move reflects concerns over the potential implications of a global CBDC, including challenges to national sovereignty and economic independence. Texas and digital assets. Texas has made a historic move by voting on an amendment to include the possession, retention, and utilization of cryptocurrencies in its state Bill of Rights. This amendment signifies a significant step toward the adoption and recognition of digital assets in the state. By including digital assets as a protected right alongside gun rights and the right to a quick and fair trial, Texas is embracing the idea that using digital assets should be considered a fundamental freedom for its citizens. The amendment's passage in Texas could potentially set a nationwide precedent for recognizing the use of digital assets in the United States Bill of Rights. This recognition emphasizes the growing importance of cryptocurrencies and blockchain technology in mainstream society. It acknowledges that cryptocurrencies, such as Bitcoin, have established themselves as valuable mediums of exchange along with traditional forms of currency. Furthermore, Texas recently passed a Bitcoin mining bill that allows energy companies to mine Bitcoin to help lower their emissions. By incentivizing the use of harmful flared or vented gas from oil wells to power Bitcoin mining operations, Texas aims to reduce carbon emissions while simultaneously supporting economic activity, job creation, and tax revenue generation. This aligns with the increasing focus on sustainable practices within the cryptocurrency industry and showcases the potential environmental benefits associated with Bitcoin mining. Overall, the regulatory developments in Canada, Florida, and Texas highlight the dynamic and evolving nature of the crypto market. These changes underscore the importance of understanding the shifting regulatory landscape and its potential impact on various aspects of the crypto industry, including exchanges, digital currencies, and mining operations. Staying informed about these developments is essential for crypto enthusiasts and investors who seek to navigate the market effectively and make informed decisions. 1 million addresses now own 1 Bitcoin or more. The milestone of 1 million addresses holding 1 Bitcoin or more signifies a significant achievement in the adoption and ownership of Bitcoin. This demonstrates the growing interest and participation in the cryptocurrency as more individuals and entities accumulate substantial amounts of Bitcoin. It reflects the increasing belief in Bitcoin's value and potential as a long-term investment and store of wealth. The milestone also highlights Bitcoin's journey toward mainstream adoption. With 1 million addresses holding 1 Bitcoin or more, Bitcoin has gained recognition and acceptance among a wider range of participants, including retail investors, institutions, and corporations. This increased ownership of Bitcoin indicates a growing belief in its role as a legitimate asset class and a hedge against traditional financial uncertainties. However, owning a full Bitcoin can pose challenges for many individuals, particularly due to the high prices associated with Bitcoin. As the value of Bitcoin has risen over time, the affordability of owning a full Bitcoin has become increasingly difficult for the average investor. The price appreciation of Bitcoin has made it a more exclusive asset, potentially limiting its accessibility to a broader audience. This challenge highlights the need for alternative investment options, such as fractional ownership or the availability of smaller denominations of Bitcoin to accommodate a wider range of investors. Gala NFT-backed anime series. Exciting news in the world of NFT-backed entertainment comes with the announcement of Rosario Dawson's involvement in an anime series called Ghost of Ruin. This project, backed by NFT platform Gala, showcases the convergence of blockchain technology and creative industries. The participation of renowned actors like Rosario Dawson adds credibility and star power to the NFT-backed project. Gala's collaboration with actors Danny Trejo and Mina Suvari for another Web3 native series, Razor, further demonstrates the platform's commitment to innovative storytelling and engaging content. These partnerships showcase the increasing integration of NFTs and blockchain technology into the entertainment industry, as well as the growing interest from established actors and production companies. NFT-backed entertainment projects like Ghost of Ruin and Razor have significant implications for the future of creative content and ownership. By leveraging blockchain technology and NFTs, these projects offer new avenues for artists, creators, and investors to monetize their work and engage with audiences. They provide a unique and verifiable way to establish ownership and authenticity in the digital realm, creating new revenue streams and opportunities for creators. Solana's new office space in New York. Solana's decision to open a 25,000 square foot co-working space in New York represents a significant step for the blockchain platform. This physical location provides a dedicated hub for Solana project collaborators and fosters a sense of community within the ecosystem. The co-working space serves as a central meeting point for Solana developers, entrepreneurs, and enthusiasts to collaborate, network, and advance the platform's growth. The space will not only accommodate Solana project collaborators, but also host various Solana-related events. This includes hackathons, workshops, conferences, and meetups, fostering knowledge sharing and innovation within the Solana community. The availability of a physical space helps solidify Solana's presence and commitment to its growing user base in New York and signifies the platform's continued expansion and influence in the blockchain space. The establishment of physical locations for crypto projects like Solana demonstrates the importance of real-world connections and face-to-face interactions in an industry often associated with virtual transactions. While the nature of blockchain technology is decentralized and digital, having physical spaces can facilitate collaboration, foster trust, and enhance community engagement. It further reinforces the idea that cryptocurrencies and blockchain are not just abstract concepts, but tangible forces driving innovation and change.